analyst here, and welcome back to Iron Financial. This is your premier explainer for helping you forge a stronger portfolio and cut right through market weakness. I'm sitting here across the desk from our resident market skeptic, and today we are tearing into AstraZeneca's Q1 2026 earnings report. Listen, we aren't just looking at generic run-of-the-mill quarterly numbers today. What we are analyzing is a high-stakes blueprint for portfolio construction. Right now, the entire pharmaceutical sector is operating under immense macroeconomic pressure. We are talking about massive industry-wide patent cliffs looming over the horizon, aggressively high interest rates absolutely squeezing capital, and relentless inflation driving up material and manufacturing costs. So this explainer is your direct line to understanding whether this pharma giant is building a durable, steel-reinforced fortress for your capital to weather that storm, or if the market is dangerously mispricing the structural risks beneath the surface. We're going to break down the revenue, inspect the debt, and drill straight into the margins with absolute precision. Let's get to work. Market skeptics stepping in right away, because hold on just a second. Before we start popping champagne and celebrating this architectural blueprint, we need to ask the absolute hardest question right up front. Is this a financial fortress, or is it just a house of cards? Look at the headline reporting 8% constant exchange rate revenue growth. Sure, it sounds like a totally solid foundation on paper, but we're in an era where massive patent cliffs are actively threatening legacy drug revenues, and those inflationary pressures you mentioned are squeezing every single dime of corporate spending. I really have to wonder if the broader market is walking straight into a pipeline-fueled value trap. We need to know right now, are we buying a highly resilient steel frame here, or are we just paying top dollar for a really expensive, glossy coat of paint? I hear your skepticism, but as the lead analyst, I've got to lay down the absolute bedrock first. The sheer weight of this $15.3 billion figure simply cannot be ignored. That is the total Q1 revenue AstraZeneca just forged in a single 3-month quarter. We are talking about a massive 13% actual growth jump. And right alongside that, they posted a core EPS of $2.58. Listen, when a mega-cap company of this sheer size and scale delivers that kind of top-line expansion, it's not like some tiny biotech company getting lucky on a single wild clinical swing. No way. It takes immense, heavily industrialized commercial execution to move a ship this large. That right there is reinforced concrete. It's a seasoned trader's dream of an earnings beat, and it shows true, undeniable operational momentum in a deeply hostile macro environment. Okay, but let's stress test that foundation immediately, because that's what we do here. Take a hard look at this stark difference between the actual growth and the constant exchange rate, or CER growth. When you strip away the currency illusions and all those nice foreign exchange tailwinds, that impressive 13% product revenue growth aggressively cools down to just 8%. It's a totally different picture. And let's heavily scrutinize that 2.58 core EPS you love so much. Yes, it grew 5% at CER, but if you actually roll up your sleeves and dig into the footnotes of this earnings report, that growth was heavily cushioned by a very favorable prior year tax rate. This is literally an accounting quirk. A tax illusion like that can artificially pad the bottom line and inflate the core EPS without any actual fresh operational cash flowing into the business. The underlying engine just isn't revving quite as hot as the headline $15.3 billion makes it seem. That's a totally fair point on the tax rate mechanics. I'll give you that. But let's look at the structural integrity of where the actual revenue is flowing from. Look at the massive load-bearing columns holding this company up. You have Oncology sitting at a towering $6.2 billion, and right next to it, rare disease is pulling in a highly lucrative $1.9 billion. These two massive sectors are doing all the heavy lifting for the entire corporate portfolio, and they are both aggressively posting double-digit growth. When your two largest, most capital-intensive pillars are expanding at that kind of sustained, relentless rate, it provides an incredibly stable load-bearing capacity that effectively shores up the rest of the business. So, moving right along into phase 1 of our drill down, inspecting these heavy lifters, specifically oncology and rare disease. We know oncology and rare disease are holding up the building, but now we really need to inspect the individual assets that are bearing that load. We need to know if these specific drugs have the patent life, the market share, and the clinical momentum to actually sustain AstraZeneca's massive valuation. Let's get granular. The explosive momentum driving this portfolio is absolutely undeniable, and HER2 is up a staggering 34% at constant exchange rates, and Imfinzi is right behind it, up 30%. These aren't just drugs, they are absolute portfolio powerhouses. Imfinzi is aggressively expanding with brand new gastrointestinal and genitourinary launches, specifically coming out of the Matterhorn and Niagara clinical trials. By successfully penetrating these new indications, AstraZeneca is massively expanding Imfinzi's total addressable market. And in HER2, it continues its relentless pan-tumor uptake. It's practically becoming the default standard of care in HER2-positive and HER2-low metastatic breast cancer. This is what top-tier commercial execution looks like in the real world. But any architect will tell you a financial fortress isn't just about explosive high-beta growth. It's about absolute stability. We can contrast the explosive growth of Enhertu with the bedrock stability of Tagrisso. Tagrisso is your steady, load-bearing backbone, pulling in a massive $1.83 billion on its own. Now sure, it's only growing at 5% CER, but it is deeply, deeply entrenched as the foundational backbone across all stages of EGFR-mutated lung cancer. Securing the frontline treatment space for those mutations provides a tremendously deep economic moat, because you effectively lock patients into your therapeutic ecosystem from day one. Then, you pair that steady, reliable anchor with Calquence at $923 million, surging 17%. Calquence is rapidly capturing market share in the frontline chronic lymphocytic leukemia market. So you have the structural anchor and you have the growth engine, and they are working in perfect tandem.
All right, market skeptic here again, and I have to concede a point to you on this one. The rare disease portfolio is proving to be incredibly resilient. The 18% and 43% surges in the constant exchange rate column for Ultomiris and Strinsiq are undeniable. Look, do you remember when AstraZeneca acquired Alexion for $39 billion? Wall Street absolutely hated the deal. Analysts thought AstraZeneca massively overpaid. But this quarter proves those early doubters entirely wrong. What's fundamentally impressive to me here is this seamless, highly efficient conversion of patients from their older legacy drug, Soliris, directly onto the new drug, Ultomiris, across all indications. They successfully transferred their entire massive revenue base to a newer, longer patent drug, successfully extending their economic moat for years to come. And Strinsiq's sheer durability for treating hypophosphatasia just shows serious underlying structural demand.
But that doesn't mean it's all perfect. Let's pivot to phase 2 of our drill down, exposing the cracks in the armor. Because we absolutely cannot ignore the income statement. It's time to aggressively interrogate the underlying structural weaknesses in this blueprint. Because when you look past all that top-line revenue glamour we just talked about, there are serious cracks in the armor that every single retail and institutional investor needs to be painfully aware of. Just look at this brutal comparison. Actual product revenue grew by 13%. Fantastic, right? But the cost of sales, it's skyrocketed by 20%. Let me put that in perspective. In today's highly restrictive, high interest rate environment, if the material costs to construct your building are rising significantly faster than the actual rent you're collecting, your building is bleeding equity. This is a glaring, flashing red flag for the company's gross margin sustainability going forward. And if you want the hard proof, just drill straight into the reported profit and loss. Right there on the second line down, cost of sales is sitting at a staggering $2.67 billion. This is a massive internal bleed. We are looking at a 20% actual increase, aggressively dragging the gross margin down. You simply cannot just gloss over a $2.6 billion expense line that is compounding significantly faster than your top-line sales. Come on, lead analyst. You need to explain what is causing this severe structural deficiency immediately, because the math isn't mathing.
I'll tell you exactly what it is. It's not a structural deficiency at all. It's exactly the cost of doing spectacular business. This margin pressure is a calculated feature, not a bug. AstraZeneca heavily relies on profit-sharing arrangements for some of its biggest, most critical heavy lifters. We're talking about Lynparza, Enhertu, Datroway, and Tezspire. When AstraZeneca records the product sales for a generational blockbuster like Enhertu, they are contractually obligated to pay away a share of those gross profits to their collaboration partner, Daiichi Sankyo. Now, why on earth would they share the risk and the reward? Because developing a drug with that kind of revolutionary, game-changing efficacy requires massive, massive upfront capital. Sharing the gross profit is the exact financial mechanism that allowed AstraZeneca to secure these huge oncology wins in the first place, without completely blowing up their own balance sheet with toxic R&D debt. Well, I'm entirely unconvinced that justifies the massive margin drag, especially when some of those shared assets are visibly stalling out. Notice the stark decay in the other medicines category. It's actively eroding by 9%. And what about Lynparza? It's one of your highly touted profit share drugs, yet it's nearly flat at a pretty pathetic 2% CER growth. Why? Because it is getting absolutely hammered by China's volume-based procurement, or VBP, implementation. For those in the audience who might not track overseas regulatory policy, VBP is a government-mandated bulk buying program that forcefully slashes drug prices. It is actively and aggressively eroding the margins of AstraZeneca's legacy drugs in international markets. So fundamentally, here is what's happening. You are paying a massive premium to your partners for growth on one end, while your older portfolio is actively decaying on the other. That is a tightrope walk.
Look, you can point at the decaying legacy medicines all you want, but I'm going to counter with the ultimate bottom line metric for literally any business on Earth: 12%. That is the increase in core operating profit, bringing it to over $5.3 billion for the quarter. How did they achieve this despite the profit share drag and the Chinese VBP generic erosion you're so worried about? By ruthlessly managing their selling, general, and administrative expenses and finding massive operational efficiencies within their R&D pipeline. This demonstrates serious operational leverage. It absolutely proves that management is ensuring their top-line growth actually translates directly into bottom-line cash flow, completely offsetting the profit-sharing payouts. The machine is working.
And that operational strength brings us to phase 3, building the 2030 ambition through the R&D pipeline. Because that operational strength we just talked about, it is directly funding the future. Let's transition to the forward-looking blueprint. To achieve their massive 2030 revenue ambitions, they need a steady, reliable supply of raw materials. AstraZeneca currently has 21 new molecular entities, or NMEs, in their late-stage pipeline. Now, for our listeners, an NME isn't just a slight tweak to an old formulation to extend a patent. It is an entirely novel, never-before-approved compound. Holding 21 NMEs in late-stage development is a staggering volume of potential commercial assets. When you contrast this against industry averages, where most large pharma companies desperately struggle to string together even 5 viable late-stage NMEs, you see the true structural strength of this company. This isn't just hoping for one lucky clinical strike. This is a highly diversified, relentlessly industrialized approach to pharmaceutical development. And we are seeing concrete progress being poured into the foundation right now, today. In just the first quarter, they delivered positive pivotal data from incredibly high-value phase 3 programs. We are talking about tazorakimab for COPD and efzimfotaz alfa for hypophosphatasia. These are massive total addressable markets. There are millions of patients worldwide suffering from COPD alone. Hitting primary endpoints in these specific trials isn't just some nice academic victory for the scientists. It translates clinical science directly into immense future structural revenue. This is exactly the kind of concrete validation you absolutely demand to see from a company that is aggressively pouring billions of dollars into R&D.
Skeptic, jumping back in. I'll grant you that the pipeline is densely packed, but let's strictly analyze the actual timeline of these upcoming catalysts. We've got major readouts coming up, stretching all the way into 2027, but we have to address the regulatory gauntlet. Having a drug succeed in a phase 3 trial is great, but getting it past the FDA, securing approval, and actually securing favorable reimbursement in a crowded, hyper-price-sensitive market, that is a completely different kind of construction project. Will this so-called catalyst-rich period actually yield enough real-world commercialized revenue to successfully offset the generic erosion and the profit-sharing margin drain we previously hammered on? Because at the end of the day, pipeline potential does not always equal portfolio profit.
Which brings us to our final phase, the verdict. Is this an opportunity or is it a trap? That is exactly what this whole explainer comes down to. We've meticulously inspected the foundation, we've drilled deeply into the load-bearing oncology assets, and we've aggressively hammered on those margin cracks. Now it's time for the final Iron Financial verdict. Let's look at the architect himself. CEO Pascal Soriot states, "We are advancing through our catalyst-rich period and remain on track to achieve our ambition for 2030 and beyond." Listen, Soriot is highly regarded on Wall Street for successfully executing one of the greatest mega-cap turnarounds in pharma history over the last decade. He knows how to build. When an executive with his specific prudent track record gives an ironclad guarantee that the 2030 foundation is totally secure, that commercial execution is consistent, and that the $15.3 billion top line is resilient, you have to give that serious weight.
The bull case is firmly locked in by the reconfirmed 2026 guidance we're looking at here. They are projecting total revenue to increase by a mid to high single-digit %, and crucially, core EPS is expected to increase by a low double-digit %. Institutional investors absolutely crave predictability. In an era where big pharma peers are frantically warning shareholders about devastating patent cliffs and slashed earnings, forging low double-digit earnings growth is incredibly rare. That kind of guided, reliable growth makes this stock the very definition of a portfolio bedrock.
In my analyst view, it's a definitive buy.
Well, as the skeptic, I won't deny the operational strengths, but let's weigh the final iron blueprint objectively before anyone deploys their hard-earned capital. Yes, the pros are massive. You have the undeniable heavy lifting of the Enhertu and Imfinzi oncology machine, plus a densely packed catalyst-rich pipeline. But you have to remember, the cons are equally persistent and structurally dangerous. You have severe gross margin pressure from those massive partner payouts to Daiichi, and you have undeniable government-mandated generic erosion eating away at legacy drugs via VBP in China. Paying a premium valuation for growth that requires you to share the gross profits is a very dangerous game if the broader market corrects or the macro environment tightens any further. So here is the final ultimate question we are leaving you with today on Iron Financial. Is the cost of growth worth the 2030 ambition? AstraZeneca is indisputably building an incredible oncology machine, but the material costs to build and maintain it are skyrocketing right alongside it. You have to independently decide if this expensive, aggressive growth strategy makes the stock a durable fortress for your capital or a brilliantly disguised, pipeline-fueled value trap. Do the math, check your own risk tolerance, and keep building a stronger portfolio. We'll see you next time on The Explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.